Welcome back to Building Blocks for Apartment Investing. Have you ever wondered how important are mission and values when it comes to working with sponsorship groups? What questions do you ask a syndicator? Or what KPIs you should look for in a multifamily deal? Well, in this episode, Trevor Thompson is here to answer those questions and more. Trevor has invested in multifamily apartments, retail strip malls, from the ground up multifamily construction, and he's here to share his knowledge with you. Don't forget to like and subscribe so we can continue to bring you professionals with awesome information to help you with your investing career. Enjoy the show. One way that we provide value is by bringing special guests like the one that we have here tonight, Trevor Thompson. Prior to investing, Trevor was a successful vice president with 47 plus years in the entertainment industry. He applied those skills to commercial real estate investing, and his success has been phenomenal. He has invested in multifamily apartments, retail strip malls, townhouse to condo conversions, from the ground up multifamily construction, and the list goes on. He has a wealth of knowledge, and he is here to share that information with us. Trevor, thank you for coming to the show.
Man, I'm excited to be here. Thanks for having me.
Awesome. And again, Trevor, from me to you, thank you. So, Trevor, can you tell us a little bit about your backstory with prior to getting into multifamily investing?
Yeah, definitely. So I'm originally from Niagara Falls, Canada, which is why my company's called Niagara Investments. I started at the very young age of 13 working for Ripley's Believe It or Not, worked there all through high school. Then I went to work for Guinness World Records, and I was there for 18 years. I actually managed the one in Niagara Falls, Canada, another one in the Empire State Building, New York City, opened up a franchise in Los Angeles, California. Then I wanted to open one in Orlando, Florida. But that deal actually fell through. But since I'd already committed to move there, I ended up opening a year-round haunted house of all things. And it was definitely a scary business. We didn't do so well. And then I promised to stay there 3 years. And literally, like within a month of my 3 years, I got recruited by a headhunter for iFly Indoor Skydiving. And then I spent 20 years with them. And I actually opened 46 of 80 worldwide locations. And very interestingly, at our first team meeting, they gave everybody a copy of Rich Dad, Poor Dad. And I did what so many people did. I read the book and went, wow, put it on the shelf and kept living my life. Kept, just applying myself to working. And then we did get bought out by a private equity company. So one of my excuses was no money, no time. I at least got a payday, so I had some money, and I started researching about investing in commercial real estate, and then I got hooked. Once I figured out the power of it and what you can do with it, I absolutely hooked.
Let me ask you a question. With your extensive background in entertainment and attractions, is there any similarities that you see with multifamily investing?
Yeah, it actually is quite a bit. It's a very customer focused business, and a lot of people don't think of multifamily as a customer focused business, but it really is, right? You are providing people where they want to live. And so your team is providing, the most important thing you can do, right, is provide a safe, welcoming environment, which is exactly the same as the attractions industry. Take care of them, make sure that you put their safety first, listen to their concerns and address it. Another thing that happened a lot is we bought back some franchise locations that weren't doing well. And it was very similar to buying an apartment complex. We went in there, we took a look at their business. We brought some CapEx to fix up the property. We brought some better systems into this to be able to bring up, we called it EBITDA. In the apartment world, we call it NOI. It's exactly the same thing, it's just different terms and different things. And I actually took over 3 franchise locations, and in all 3 of them, more than 30% increased EBITDA, which is NOI, which is exactly what we do in apartments. So it was unbelievably transferable.
So, with this being a customer-based business, how important are mission and values when it comes to working with sponsorship groups?
Oh, it's huge, absolutely huge. Like I always tell people when you're looking to invest, you want to pick people that think the same way you do, have similar values that you have. They want to do things. A lot of people get into business and they're only thinking about the money side of the business. And I actually think that's kind of the last thing you look at. So for apartment complexes, the way I always like to look at it is, the tenants are our first priority, making sure that we're providing them a safe and a comfortable place to live. Then our second priority is the team that works there, making sure that they feel empowered to deliver the correct experience, that you've given them the tools to be able to do a good job. And then third is our investors. So if we do number one and number two really well, it helps protect the investors' initial capital and then helps them grow their capital. So they're kind of the third. And if you don't have partners that are kind of aligned in that sequence, I think you lose a lot of potential for doing well. If you make it a great place to live, people don't move out, or they'll move in because it's better than where they live. People's houses, you got to think about it. Spend a lot of time in your house, your family there, you create memories there. And if we can create communities that do those things, my goal is that the tenants would say, come to my house, not come to my apartment, or to my home, I should have said, not to my apartment. And if you can create that kind of thing where they feel that it's their home, powerful, very powerful.
So what do you ask for when speaking to syndicators and operators in your initial meeting?
Yeah, so I always spend a lot of time researching people. So I've spent up to a year researching syndicators before I've invested with them. I like to go to meetups just like this and listen to them talk. I like to go to when they're holding their own webinars and presenting. I like to go to their first a couple of initial offerings and look at what are they talking about, what's important to them. And then of course you take it to the next level, you connect with people that have invested with them and you ask them some clarifying questions. And then you got to dig that third layer, because you got to find the person that isn't happy before you know the whole story, right? Nobody can ever make everybody happy all the time. So you got to find that the next rail, which is, hey, I wish they'd have done this. I wish they'd have done that, because you need to understand exactly what you're getting into, because you worked hard to get that money that you're going to invest. And you want to make sure, first of all, it's safe. And second, it's going to grow.
Absolutely. So along that line, when you're talking with your operators, and once you've decided to invest in that opportunity, do you take that sponsorship team's underwriting that you get, or do you do your own underwriting to verify their numbers?
So what I do is, I'm actually not a very good underwriter, which isn't a good thing for a syndicator to admit. So I surround myself with people that are really good. But I look at what I'm going to, because I've obviously invested, I've invested in 18 syndications. I've had a couple that didn't go as well at the beginning when I learned, but I look at there's a couple of real key things. So number one, who you're going to give your money to, number one, most important, right? Make sure that you know who they are, you're aligned in values. Number two, you want to look at some of their assumptions. So to understand their assumptions, you have to have some education. So you want to know, okay, where is the asset? What are the current rents at the property? What are their projected rents in the property? Can the people that live in the community afford those rents? So for example, rents are $800. We're going to tell you we're going to $1,000. That means the people in that neighborhood should be making $3,000 a month, 3 times income. And if you go and you can find that on city data, it's easy to research. And if you find, hey, they're not making that kind of money in that neighborhood, achieving $1,000 rents is absolutely impractical. You can look at some competing places around the property just to see if they're in line. Then you want to look at some of their projections to make sure that they're really accurate. Do they have enough money in their capital expenditure budget to implement their plan? Do they have a realistic timeline for their plan? A lot of people don't understand and look at that. Like when you're going and investing in a deep value add or a value add project, it can often take about 18 months to implement your plan. And a lot of new syndicators just don't understand that. And they'll say, oh, we're going to renovate all these apartments in 3 months. Well, you can't. There's a lot of people with leases in place. You can't get them out. You can't move them along. You can't turn a community, you know. And so I look at their plan, right? Where are they spending their money and when? And that helps me decide, okay, do I like what they're going to do? And then there's some things that are a little more complicated and take a little more things. So what was their purchase cap rate and what's their exit cap rate? You want to make sure they're showing an exit at higher than their entry. Usually about 10 basis points per year. It's going to fluctuate. I think it's going to skip around a bit with the high interest rates right now, but those are the kind of things you want to look at. Is their plan believable? And then, you know, at the end of the day, you just got to go, okay, I trust these people. I've checked the basic facts of the plan. I've done my research. And then you want to make your, you know, then you make your decision to make your investment.
You've basically laid out the steps that you take in order to decide whether or not you want to invest passively with these operators. About how much time is being spent doing all these steps, the research, basically looking at the various things that you've already discussed?
So a huge amount of time in the who, right? So a huge amount of time in the who, like I said, I went to people's events like 1 or 2 times a month for a year. And then they actually had some courses that they did and some other things, you know, just because I wanted to really spend the time looking for the who. Then once I get the who, I look for some of my other parameters. So some of my parameters are, I like to invest in pro-business, pro-friendly landlord states. So right now I'm in Arizona, Texas. Most of my investments are in Texas and I live here, and the Carolinas. Those are 3, you know, so I kind of look for the jockey first, then I call it the horse, which is what asset class, and I'm in a couple other than multifamily. And then the track is the where. So the where first starts at the country, and I'm not investing outside of the United States. Secondly, the state. I'm looking for pro-business, pro-landlord friendly states. And then I'm also looking for micro, like for example, we all know the wrong side of the tracks, right? So you literally can be a mile apart and you might as well be 100 miles apart in terms of neighborhoods, right? Because you go to the other side of the highway and that's where those other people live, not where I want to live. And it doesn't mean that you would never buy there, but you need to understand it. And you can start looking, when you start looking at the income brackets, it's really quite amazing. Like I've looked at some and literally a mile away goes from $42,000 a year to $62,000 a year. And if your property is in the $42,000 a year, you're not going to be able to achieve big rents. But if you're in the $62,000 a year neighborhood, because people don't normally move very far unless they get a job change, right? Most people stay within a very tight geographic area, less than 5 miles.
So when you're getting into a deal, what are the top 3 KPIs that you look for in an investment?
Yeah, so for me, I always want to look at, is there a preferred return? That's really important to me. And I'll explain a little bit about what a preferred return means. Preferred returns means that the limited partners get paid first. So for example, I just signed up on a deal today and it has an 8% preferred return. So that means I'm going to make 8% before the sponsors make any money. Okay, so I get paid first. So they're motivated to get paid first. Secondly, the number that's most important to me is IRR, internal rate of return, just because it kind of like it. If I doubled my money in 10 years, it's not near as exciting as double my money in 2 years. But the IRR, it kind of does that math for you. So I always look for an IRR at least above 15%. I'll be honest, when I start seeing big IRRs, I lose faith in the deal, right? My mom always told me if it was too good to be true, it probably is. And you know, you get these people saying, but man, I'm going to pay you 22% IRR. Too good to be true. I don't know. I lose confidence. So in those particular factors. And again, you want to also look, there's no magic timeline, right? Most deals are kind of in a 5-year period, but you want sponsors, sometimes they'll give you a 3 and a 7-year, hey, if this happens, we may get out here, or we may get out there. So for example, one of my deals, it was supposed to be a 5-year deal. They got out in 20 months. Well, why did they get out in 20 months? Because they got an offer that tripled, if you can imagine, tripled my money in 20 months. I'm glad they got out of the deal, right? And that money came back to me at triple what I invested. It was my best investment to date. So they accelerated. They only promised it 2 times my money in 5 years. And of course, it was an IRR of in the 40s, where they were projecting about a 17. So again, better than, but I'm not sure that's going to happen in the next few years. It happened during where everything was really that cheap. But once I figured out who do I like, I start looking at their deals, right? And I don't look at other people's deals. Then I look for what I'm going to call the trifecta. So for example, there was a person I wanted to invest in. She sent me 3 different deals. I passed on all 3 because they just didn't fit some of the other things. And then boom, the 4th one she sent me, I wanted to get in storage. I wanted to get in North Carolina, in particularly near Charlotte. And boom, she sent a new build storage just outside of Charlotte, North Carolina, and all the stars aligned, right? Because I was looking to do a storage investment. I was looking to do a new build one. I liked the way the plan was. And one other thing that, I don't want to get too complicated, but this one had a waterfall. So what their metric was when they achieved doubling my money, the split went from 80-20 to 50-50. And a lot of people think you're going to give 50% to the sponsor. And I'm like, no, double my money, baby, double my money. Because if I do good, I want you to do even better. I want you motivated to double my money in that period of time. And so that's another thing I do look at. I'm not afraid of it. I actually like it because it aligns everybody's interests, right? If I hit a home run and I work really hard and I get everything, I'm going to make a little bit more money, but you're going to make more money too as an investor. And I like that because that's the true definition of win-win, right?
Oh, absolutely. Absolutely. I know if you were really paying attention, so far, Trevor has been dropping nothing but golden nuggets.
Oh, wow. That was a lot of information, and he has a lot more in store in our next episode. If you would like to support this channel, one of the best ways to do that is to like, comment, and subscribe. All those things signal to YouTube that you see value in these videos. So make sure you click that alert button, and I'll see you in part 2. Do, re, mi, fa, sol, la, ti, do. Do, a deer, a female deer, re, a drop of golden sun. Me, a name, I call myself, fa, a long way to run.